Hi, good morning, everyone. Welcome back to the channel. So I'm back today with a special guest again, Howard Chen of Curve Funds. Welcome back, Howard. It's so great to have you back on.
Hi, Coach. Great to be back.
Yep. So we've been really impressed by your fund's performance, especially the Tesla fund. Do you want to talk a little bit about that? And I'll get a chart pulled up here.
Sure. I think the last time we came on here, or I came on here, we were describing how our methodology is a little bit different. We tend to balance a bit of price appreciation versus income generation, and I think now we're 8 months in. I think that has started to really prove out. Um, we are able to generate pretty good distribution from our single name cover call strategy while capturing quite a bit of uh, price appreciation as well. And I
Mhm.
think especially, you can see in Tesla is kind of an interesting test case, which is from the beginning of the year, it's been sort of falling and we've been outperforming the stock. And then in the beginning of January, we saw these little price spurts uh, in Tesla, the stock. And so we were able to really capture some of those price appreciation when they happen. So that's sort of a test case, a proof point to our theory that a lot of technology stocks have these little price spurts. And then you want to be able to write your call a little bit out of the money to capture some of that increase in stock price.
Mhm. And so remind the audience again how your strategy is different from others because you're going closer to the money.
Now we
Right.
write a little bit out of money,
A
usually
lot of
about
money, yeah.
30 delta. So that for Tesla specifically, it's about 15% out
Mhm.
of money when we roll. And then we generally write monthly calls instead of weekly or shorter on our strategy.
Okay. You have the chart up here. Looks like it's really mirroring um, Tesla very close.
Yeah. So in down markets, we generally would be able to capture all of the premiums that we write, and then
Hmm.
in up markets, we can capture more of that price appreciation.
Hmm.
Yeah.
Yeah, and if I look at total return here with the dividends reinvested, it's definitely outperforming Tesla stock.
Which is actually, to be very honest, very unusual for cover call strategy, right? That you're
Right.
actually performing the underlying.
Hmm.
And that is actually, to be very honest, the beginning of the year, the Tesla stock was falling, so we were able to harvest all of the premiums. Most of the cover calls were um, expiring out of the money, so we were able
Hmm.
to fully harvest the premium, and that added to returns, total returns in the strategy. Yeah.
Hmm. Awesome. So you've mentioned also, like for the rest of 2024, you're planning on increasing distributions on four of your ETFs.
Yeah,
Yeah.
that's we released the news last week, and then the actual distribution came out yesterday.
Hmm.
So we were happy to announce that for four of our six funds, we're able to increase distribution for the remainder of the year. Uh, I again, I think if you're viewers remember, we are pretty cautious in terms of how we distribute from the funds, especially we want to guard against NAV erosion and
Right.
reverse stock splits. So we typically only look to distribute the premiums that we harvest from the cover call. And then we have sort of a bank in the fund that, 1 month when we have more premiums, we bank some. And then in the months where the premium's a little less, we use the bank. So we can smooth out distribution because we know a lot of people are using these to supplement their income.
Hmm.
But one of the benefits of doing this is that for the names that actually, the underlying that has done very well, we actually have extra gains in net, what they call net investment income in the fund. So we looked at a projected what that amount would be to the last remainder of the year, and we split it out for the last 5 months. And so we're able to increase distribution for the remainder of the year.
Great.
And the increase is typically about 15 to 20% of what it was before. So most of the funds we expect are going to be at least 15, 20% of distribution rate. Tesla, of course, is always the highest. It's around 30, 25, 30%. So now it's even for the less volatile names, it's a pretty healthy distribution. We're looking to maintain that going forward. Yeah.
Hmm. Yeah, for sure. I see. Yeah, 25% almost.
Yeah. So the new distribution rate number will come out at the end of the month because that's how the custodian calculates it. So that's still the previous month's distribution rate.
Hmm.
Um, yeah. But if you could look at it basically from dollar per share. So Tesla is not actually one that we increased because it's already pretty high. If you take a look at maybe Netflix,
Hmm.
you can see there's just been a lot of net investment income that we can distribute to
Hmm.
investors. Yeah.
I did notice with Tesla though, that's like your highest dividend in 5 months.
We keep increasing it if we can.
Hmm.
Of course, our goal is to not have NAV erosion, but to the extent that we have extra premium in the bank, we want to uh, redistribute it to the investors.
Very interesting. So yeah, this is for the Netflix one. This is your highest payout.
Yeah. Um, I know when we first came on here, the funds were very young, and we mostly were talking in theory about what it would happen. And now we have history and kind of how the funds are actually doing, and a lot of our proof points are coming out to be verified and true. So I hope people can look at it and say, hey, we actually thought really critically about this, and
Hmm.
the design of our strategies is uh, you know we thought through what it would imply in the market using a lot of our the expertise on our teams. And now it's always under promise over deliver, so we want to make sure we have good healthy distribution without eroding into NAV. So
For sure. That's the biggest concern I hear from the audience is NAV erosion. Um, and like if we could get a 20 to 25% dividend with very minimal to no NAV erosion, I think that's really the sweet spot.
we try. We
Hmm.
try. We can't promise anything, but we do look at it. The PMs, we keep track of all the numbers in the funds to make sure we're not over distributing. Yeah.
Hmm. So since we last talked, it looks like you've got this Titans fund. That's
Yeah.
new. Yeah.
We launched it at the end of July, and I have to admit, it was slightly a component. It was slightly inspired by our last chat, actually,
Oh
with
yeah.
you and your colleagues, actually.
Yeah.
So we've always, every time we have been on all of these channels, that the most common question is always, oh, are you going to come out with a funds of funds,
Hmm.
right?
Yes.
And so we didn't want to just do an ETF of ETFs because there's stuff out in the market already, and we wanted to really think about what kind of exposure we want to have in our own portfolios. And we were trying to address a couple of different things, which is we know that people wanted a basket of names, right, for diversification. And
Hmm.
and here's actually a really interesting point that happened since we last talked about was, other than this recent correction in technology, vol for indices actually have fallen to 4-year lows or whatnot, to a very low level. So when you're writing cover calls, like, the vol premium is pretty compressed. You're not going to
Hmm.
get a lot. But there's actually was a divergence in terms of single name versus indices, because indices in itself has a lot of names, so it has diversification that lowers the vol that you can harvest, right? But single names, the implied vol is still relatively high. So what a lot of people do to do this trade of this divergence is to buy a basket of single names,
Hmm.
because what happens is you clip in an index, you have diversification, and then you clip the coupon from the cover calls, right? But if you buy a basket of single names, you're clipping the coupon first, which is higher, and then you're getting that diversification but from buying multiple names. So there's actually this basis trades that's happening between the two.
Hmm. And so
Um,
this fund is holding the shares directly?
yeah. So
Yeah.
I'll get so the premise was this. Okay. So we did look at where in a sweet spot for technology is, and we found that the largest technology companies still has incredible pricing advantages, and oftentimes, they're dominant in their verticals.
Hmm.
And if you look at, we did a 20-year study going back, the largest 15, 20 names, technology names, have, at least in the last 5 years, have actually outperformed the overall broad index, the NASDAQ 100, by almost 4% every year. And that divergence has actually increased. And I know a lot of people this year have heard, like, oh, most of the market was driven by 7 names, right? And then what happens to the rest of 493? But that phenomenon has been happening for over about 10 years. And it's
Hmm.
not just the top 7, it's actually a big basket of the largest name. So we wanted to start from there. We wanted to pick the largest 15 to 20 names that is not based upon where they're listed. So if you look at, actually go to Triple Q or something, you look at the top 15 names, you actually have names that are not technology focused, like
Hmm.
Pepsi and Costco. So we're very careful in terms of, we don't care where the technology names are listed, and we eliminate names that are not technology names. So we
Okay.
get that basket of 15 to 20. And then we do something a little bit, I think most of your audience would understand, is that most technology names are growth companies, and growth companies have momentum. So we do when there is upward price momentum, we overweight and underweight names.
Hmm.
So the average run for a cycle and momentum for tech stocks is about 10 months. So we have signals that kind of start overweighting the individual names when it's at the beginning of that cycle, 2 or 3 months into it. And then we overweight again when it's like halfway, so like 5 months into it. And then so then you get, you're overweighting the names that are doing well. So for instance, Nvidia had huge momentum this year, right? So
Hmm.
we would slightly overweight that over others. Then the question is, well, what happens with the ones that don't have momentum or have negative price momentum that they're falling? That's actually the perfect time to write a cover call.
Hmm.
So when you're writing a cover call, you're sort of trading up some of your upside for the income, right? And
Right.
it works really well when the stock is falling, like the Tesla example, or trading sideways, or it's going up slowly. So these are the ones that have low positive price momentum. And it's the perfect scenario in which we write cover calls. So we do still write cover calls in this basket. And one of the things that is actually cool about this feature is there's a counter cyclical feature about it, which is what happens when we have a market correction, like in July. So
Hmm.
all of the names now have negative price momentum. So we're writing cover calls on every single name in the basket. So you actually have this thing where when the market is falling, you're generating more income, you're actually mitigating the downside. So you have this downside mitigation, and it's counter cyclical.
Hmm.
And then this is the part where I was inspired by the last conversation we had, because somebody had mentioned, well, you know, do you change the way you write cover calls? Because in a market of correction, there's higher volatility. Implied volatility goes up, you get more premiums. And
Right.
so actually, this is a really interesting feature, is that when the market corrects, we actually generate incrementally more income because vol goes up.
Hmm.
And our cover calls can generate additional incremental premiums to mitigate the downside. So it has a built-in sort of downside mitigation. And so basically what we were trying to do in the strategy, which is really what a lot of traders do on the option side, is to have asymmetric upside and downside, right? So we didn't want to just stick with the cover calls, because we do think in some ways, tech stocks have this spurts of upside. So when things are going up, when the market is going up and there's momentum, we ride that wave, we don't cap it. And when the market is going down, we write covered calls to generate income. So
Mm-hmm.
that also means the characteristic of this fund is a little bit different than the first six. The first six is, let's try to make the distribution as consistent as possible without NAV erosion. This one, the income is more dynamic. It will range between 4 to 12%, but it will have higher distribution when the market is going down than when the market is going up.
Nice.
So we compare ourselves in this fund against Triple Q. Triple Q distributes 0.62%. This one we just announced distribution last week. It's
Yep.
annualized to be 4%. So
Mm-hmm.
we're trying to produce a healthy premium distribution relative to Triple Q on this fund as well.
Yeah. So the benchmark you would say is the triple Q.
The Triple Q, yeah.
Okay. Um, I was almost going to mention like a FEPI. I know FEPI pays like a 25% or so, but they're actually directly in the stock instead of like the covered calls, like the Yield Max fund. Not to throw around competitors, but
Yeah.
yeah.
Yeah, so I think it's a little bit in a different category because we actually look to outperform Triple Q when the
Hmm.
market is going up. I don't think there's an expectation of that with cover call strategies, right? Because you're trading some of the upside.
Hmm.
And so I think the way I think about it really is you have total return and there's two components, right? You have price return and you have income return, right? And in some ways, cover call strategies are very focused on the income return.
Hmm.
And the way we run it is we have some price return, right? But in this one is when the market is going up, the driver is price return. And when the market is going down, the income return comes up. So you have these
Hmm.
two
Offset.
drivers of total return. Yeah.
Hmm.
This seesaw that's happening here.
Hmm.
But we're still fans of cover calls. We still have the first six; those are meant to be tools. It's sort of a different investor set, right? The first six are meant to be dividend income focused investors who want to clip consistent coupon on a monthly basis to supplement their income.
Hmm.
This one, and I would say those tend to be a little bit older, or they just want to have a fire life, right? Like that
Yeah.
kind of mantra.
Yep.
This one is, sort of in the vein that I have some time. I want to ride some price appreciation, but I also want to clip some coupon. So you have to make that balance there. Uh,
Hmm.
so yeah,
And I noticed the expense ratio is structured like some of the others out there. So it's like the 0.99% plus an extra fee for what do they call it? You've got it listed as it looks
acquired
like
quantity. So actually,
yeah.
the pricing is a little bit complicated because of how we have to disclose it. But the goal
Hmm.
was to actually price this at 99 basis point, which is the same as all the other funds,
Yeah.
actually.
Yeah.
So when there one of the things that we can do, which I forgot to mention, is in the case where we want to write a cover call and we have a name that we already have in the first six,
Hmm.
we can use that. So that kind of goes into the whole, would you do an ETF of ETF? It is in the vein. We built it in so we can use one of the first six. And if we use our own funds, we have to disclose for the first year estimate of what that fee would be. We kind of overestimated it a little bit. So so the goal is basically this will be priced at the same price as the other six. Yeah.
Hmm. And so for new audience members that may not know much about the curve funds, can you explain again the chart, the historical premium discount chart to them?
Yeah, so the historical premium and discount is just looking at the difference between market price, which is the price that you can trade on exchange, and
Hmm.
NAV price, which is at the end of the day, the custodian prices all of the assets and see, what is the daily, we have to publish a daily NAV. So um, during the market, there are price movements, and oftentimes people execute, using limit orders, etc. So it's just that difference. When it's at a premium, it means that the market is pricing the fund higher than what the net assets is valued at the custodian. And when
Hmm.
there's a discount, the market is valuing it less than what the net asset value is.
That's right. And I see that you actually list out nav calculations done at 4 o'clock Eastern
That's right.
every day. Yeah.
Yeah. And actually, I realize this is actually a point that maybe not a lot of people know, and it's always worth kind of. It's like we get this question of when should you execute.
Mm,
Um, so our advice is you always avoid the first 2 hours of the market, and you avoid the last hour of the market.
mm-hmm,
And the reason is, while the shares of the ETFs are traded on exchange until 4 p.m. Eastern Standard Time, the ordering of new shares from our fund actually closes an hour before.
mm-hmm,
So when the market makers make prices, they actually widen out the bid-ask spread a little bit because they have what they call overnight risk, because they have to wait until uh, overnight to the next morning to create more shares or redeem more shares from us.
mm-hmm,
And so to buffer in any kind of overnight slippage, you can actually see this on screen, is the bid ask will widen out around after 3 p.m. So to get the best prices, and you generally want to maybe avoid the start of the day, because a lot of overnight limit orders gets executed. So you oftentimes see price swings in the first hour in the market.
mm-hmm,
So if you want to get true prices with closest without discounts or premium on the chart that you showed, is that you want to execute during the day.
mm-hmm.
That's usually the best time to with most ETFs, not just ours. So
Right. And I have noticed too, after hours, the chart will fluctuate a lot too.
yes, and
Yep.
and I caution people using limit orders after hours, is
Mm-hmm,
because a market maker can just pick up at any price, uh, execute the limit order at that price, but the underlying prices of underlying the price of the underlying assets may have moved. So you can see these like huge fluctuations during after hours. So that uh, be cautious about executing after hours. Liquidity is poor also.
mm-hmm. Yeah, very interesting. And then yeah, I see the 30-day median bid ask spread here in
Yeah.
the on the site.
Oh,
Yep.
and going back to your question, so in
Mm-hmm,
this fund, we do actually hold both stock and we also do synthetics. So if you look at the larger positions like Microsoft or NVIDIA, you have to actually download the holdings because we have a lot of holdings on there.
mm-hmm,
Uh, some of the exposure is the long exposure is through stocks, and then some of it is through synthetics, actually. And it's the same reason why we do it in our funds. We make this decision between whether it's cheaper at the time of execution to get equity exposure, or if we just get the exposure through buying a call, selling a put of the same strike, which is what the synthetic is. The benefit to doing that is that usually use less capital, and you can put the remaining capital in a yielding asset like a T-bill or something like that that yields 5.25. Here we use a money market funds that's yielding, above 5. So
Oh, I see that. I have the detail holdings here, and so you'll have a stock like Apple, and
yeah,
then you'll have a call and a put.
yeah,
Yep.
yeah. So we're really trying to optimize for the investor how to get that long exposure, and that's independent of whether we write the call or not. Yeah.
Hmm. So you have the call and the put at the same strike.
Yes.
Hmm.
Uh, that will give you a similar economic exposure as holding the stock. And
Hmm.
it doesn't technically matter where the strike is. There's some differences in the implied financing rate, but um, you get the same. If the stock goes up, the call will rise in value. If the stock goes down, the short put will lose value. So you get the same economic exposure as the stock.
I see. Yeah. Yeah. Awesome. Okay. So and then of course the next question is going to be so now that you have the KQQQ, are you working on one for the Russell or for the SPY?
No, we are
No.
not. We have some other funds that we're working on that addresses. I think the key thing about, and maybe for the new folks on the audience, is like um, what is the mission of Curve, right? And so
Mm,
what we want to do is to uh, figure out strategies that are tax efficient, tax aware, and institutional grade strategies to make it available for all investors. And I go into this because we've worked at some of the largest firms and worked with huge pension funds and endowments, and their strategies are really great in generating returns, but
Hmm.
they're really tax inefficient. And it's okay for them because they are non-taxable entities. But as soon as you use those strategies for taxable entities, individuals, or even through advisors, or large, they become extremely tax inefficient. So one of the features for us in all of our strategies, how can we actually think about taxes as part of the strategy? Um, you know, the common way of doing it that people do is tax loss harvesting, but that
Hmm.
implies you have to have loss, and we're like, no, we want to optimize tax on the gains, right?
Right. Right.
In this portfolio, we do look to uh, if there's losses, we offset that with something else, and we have mechanisms to kind of remove short-term capital gains. So we want to make this strategies as tax efficient as possible in an ETF wrapper that people can get exposures to. Now, in terms of having other beta exposures like S&P 500 or Russell, I'm guessing 200, the small cap, 2000. I think we don't have an edge there. I think there's lots of other products out there that's clipping coupons. We are working on some other interesting things in other parts of the portfolio that's not equity related, that once we uh, those are fully formed, I'd love to talk to them about it, talk to your audience about it. And those are
For
also
sure.
meant to be tax efficient strategies for people to use in their portfolios.
Hmm. Awesome. So speaking of taxes and tax efficiency, um, can you briefly discuss like return of capital and like what portion of the dividends that might be classified as a return of capital?
Yeah, I'll talk about the 6 funds that we have. So we
Mhm.
just actually, our fiscal year end for the trust is end of May.
Okay.
And we just actually did this calculation for that year. And for the calendar year 2024, 98% or above 90% are all return of capital for our
Okay.
funds.
Okay.
And for those audience who don't know, is that most of the distribution you get from funds or investments is in the form of dividends or interest payments. And
Hmm.
those are typically, and I'm not a tax consultant, everybody's tax situation is different, but those are taxed at ordinary income.
Hmm.
So basically, probably the highest tax rate
Exactly.
available.
Yeah.
But in option funds distribution, um, there's actually a tax form on our website that you can see this somewhere on
Okay.
the website. But you can when you distribute those, some of the distributions are not immediately taxable because they're categorized in a different bucket by the IRS called return of capital. And
Hmm.
so what happens is at the end of the calendar year, so our fiscal year is May 31st, but at the end of the calendar year, you do another assessment, and anything that's categorized as return of capital is not immediately taxable. And what happens is your brokerage will lower the cost basis in which you buy your investment. So if you hold that investment for more than a year, it becomes long-term capital gains, which for most people would be a lower tax rate.
Yes.
And if you hold it for a long time, you're actually doing something you can do in an IRA, which is you're compounding your returns, the portion that is your return capital. You're compounding your returns if you reinvest it on a tax-free basis. So it's basically what you can do in an IRA and non-taxable account in a taxable account. You're deferring the tax until you sell the security. And if you don't sell the security, you never incur that cap gains. Uh, at some point, you probably will sell it and you will incur that tax. But while you're holding that and reinvesting it, it can compound tax-free.
That's awesome. So another question, is there a target yield range for the KQQQ? And do you overwrite on 100% of the portfolio for their funds?
Yeah, so it's a good question. So
Hmm.
we generally, with our 6 funds, we look to not have NAV erosion because we don't target a yield. we distribute what the market gives us, which is when we write a call, that premium the market gives us, we will distribute that. Now, that generally turns out on average to be similar yields, but when we don't promise, say, our distribution, 60%,
Hmm.
because oftentimes when you do that, when the market gives you less, you're going to have to eat into NAV, and that's
Hmm.
oftentimes how NAV erosion happens, right? But just generally, market vol tends to be, other than spikes in vol, they tend to be pretty steady. So you can see on average our Tesla funds generating 25 to 30%, but we never promise 30%, right? If
Yeah.
1 month is 25, that's what we distribute.
Hmm.
Now in KQQQ, we have a special feature, which is that, sometimes the momentum, you need to take a few months, right, for it to
Hmm.
see which direction it goes. So what we do is when they're starting to not have positive price momentum, when it's going down or on sideways, we start writing cover calls, but we leg into it. So we'll
Hmm.
start with 50% of what the underlying long exposure is, and then if uh, that negative momentum keeps happening, then we write 100% of that name. So meaning we look at stock, there's 15 to 20 names in the portfolio. Let's just say the largest component is Microsoft, right? That's in largest component is. If Microsoft starts to exhibit uh, non-positive momentum, right?
Hmm.
It could be sideways or negative, or we leg into it by writing 50% notional of the name. And if it continues for more than a few months, then we write 100%. But we do that for every single name. So there's some times where a name is turned on, the cover call writing is turned on, and others are turned off. But in aggregate, we look at an individual name. And again, in market sell-off, where everything has negative price momentum that we see in beginning of August, most of the cover call writing will start to turn on, right? But it has to be a longer horizon of like over months. So we do that slowly, and then of course we turn off the cover call writing slowly also. So when we roll and there's exhibits slow price momentum, then we move from 100 to 50 to 0.
Okay. Interesting. Um, okay. So anything else that you wanted to discuss from what you mentioned in the email, or did we hit on everything?
No, I think we just wanted to thank all of our investors in the first 6 funds for
Mm.
trusting our methodology. I think a lot of people came into the funds, believing us, but now we can actually have investment returns to prove out our theory, and we hope
Yes.
people have upside surprise in terms of the increased distribution for the remainder of the year. We will continue to guard against NAV erosion, and then with the new funds, we hope this is sort of a new twist on people thinking about how to have cover calls and a basket of technology names in their portfolio.
Hmm.
Because one of the things is, if Nvidia goes up 60%, it might be better to write up the 60% and sell a little bit of shares to get your income, right? I know this operationally that's a little bit of a hassle, but
Hmm.
like you can have so much more for income if you just write it up. So we want to have this almost best of both worlds, where we ride the upside and then we cover our downside. So
Yeah.
that's the intention. So I hope people appreciate that kind of methodology. And again, people will have to trust us, and then hopefully in a few months we come back and say, hey, this is working out the way that we intended to.
Yeah. Yeah, for sure. Sounds good. So last question. Looks like you've got a lot of interesting books behind you. Are they all financial?
None of them are actually financial books
Oh,
behind this. I have another
uh-huh.
bookshelf in front of me that has financial books.
Oh,
No,
cool.
jokingly, people
Yeah.
people say I interview in the same place too many times, so I'm
Oh, yeah.
trying to switch up the
Hmm.
the background.
Yeah, I've gotten the same thing too. That's
Yeah,
funny.
yeah.
Yeah. All right. Well, great chat. Thanks for coming back on. We'll definitely have you back on in a couple months again. And yeah, good work with the funds. Very impressive.
Great. Thank you.
Yeah.
Appreciate the
Uh,
time.
yeah. All right, everybody. Thank you for tuning in. Like, comment, and subscribe, and check out the Curve website. And we will see you all soon. Take care. Bye.